What's up, everybody? My name's Kevin, and today I'm gonna make a little bit of, I think, an unpopular argument, but even if you think the title is something that's upsetting you because you like stocks, know this. I like stocks as well, and I'm starting this video off with the uphill battle of saying why stocks always lose to real estate. Now, I'm going to set this up, I'm gonna explain everything here, and if you're going into this thinking, Kevin, you're mad, you might learn something you haven't thought of before, so give it a shot. And if you already like real estate, well, stick around as well because you might also learn something. Let's get right into this challenge. Now, I think this goes without saying, but this is for entertainment purposes only, and don't sue me, bro. Just debate me in the comments. If you have more than $500,000 to invest right now, or your net worth is already millions of dollars, fine, maybe this video isn't for you. But if you are part of everybody that has less than $500,000 to invest and your net worth is not millions of dollars, then this video is specifically for you. Now, I'm not here to tell you that some hedge fund billionaire is going to make more money investing in small real estate deals like houses and duplexes and fourplexes, but I am here to tell you that if you don't have a lot of money and you want to finally build wealth, you're probably going to be able to do it the fastest through real estate, and here's the proof. Let's say today you had $20,000 to invest, and you were wondering, all right, well, where should I invest this? And you think, okay, well, I can put it in high yield savings, and let's go ahead and invest that in high yield savings for, let's say, 20 years. Well, after 20 years of your $20,000 in high yield savings, you will have $28,500. Congratulations, you have made money on your money, or you've matched inflation. Okay, let's now say that you invested this into a bond fund, like a municipal bond fund or something like that, and you made 5%, since you get some tax benefits and all that. Let's just say you made 5%. Okay, cool. Your $20,000 after 20 years would be worth $53,000. Cool. You 2.5x'd your money. That's awesome. Now, what if instead now you invested into the stock market, like a Dow Jones index fund or the S&P 500 index fund, and you reinvested all of your dividends and you were able to make 9% on your money? That's pretty awesome. 9%, that's great. A lot of people would love to make 9% on their money. Banks and most people would love to make that kind of money. Well, that $20,000 after 20 years would turn into $114,000. That's also pretty good, right? What if you now invested in a crazy, really good syndication that said, oh my gosh, we're gonna return 12%. We'll give you some cash flow in the meantime, and we're gonna get you 12% on your money. Sweet. Your $20,000 would turn into almost $200,000 after 20 years at 12%. That's really, really cool. Now, forget about all this compound interest math for a moment. And let's think about the other option, investing in real estate. See, right now I just went through a bunch of fictitious sort of potential returns that you might make investing in savings or an index fund or stock market or a syndicate or whatever. And that's not to say that you're definitely gonna make 12% in a syndicate and you're definitely gonna make 9% in the S&P 500. I'm just making things up. But all of those numbers are pretty good. I mean, if you picked one of those vehicles, that's probably what your goal would be. And you'd be thinking, all right, cool, my $20,000 is gonna mean something in 20 years. All right, well, I mean, that's just boring compound interest math, right? Now, before I say this though, just remember what I mentioned for the other options. I said you'd reinvest your dividends in stocks. I said if you had a syndication, you'd be making 12% on your money and you would turn your $20,000 into like $192,000, almost $200,000. So it was really generous to all of these options. I think those are very generous rates of returns. Now, in real estate, I'm going to be as modest as possible here, and I'm gonna say you're going to take that $20,000 and you're going to buy a basic $300,000 property. Maybe it's a duplex, maybe it's a single family, I don't care what it is, but what I'm gonna do is I'm gonna strip all of the potential cash flow that deal has. That is rent increases after 5 years, rent increases after 10 years, nothing. You literally have zero cash flow for the entire 20 years. Maybe you live in it for the first few years and your payment kind of matches what your rent is. You're putting aside money for fix up, but all in all, your potential cash flow on that deal for the entire 20 years is zero. It literally makes you no money. You spend all of it on repairs and fix up. That's it. So I think I'm being really, really fair to the other options, and I'm robbing a big benefit from real estate, which it is true that even if you put $20,000 down on a $300,000 house, even with mortgage insurance and all that, if you don't cash flow day one, you'll cash flow after a few years of rent increases in time. So super simple here, $20,000 to lock up a $300,000 house, no cash flow. And let's just say you paid market value for it. You didn't even get a good deal on it. Which, if you've watched this channel before, you probably already know that I'm all about teaching you how to buy real estate below market value. That's what I teach you in my real estate investing course. I teach you how to manage your own property. I teach you how to cash flow better. I teach you how to save money on renovations. That's all in the links below. But for now, we have a $300,000 house that we bought with $20,000. Now, let's assume the value of that property goes up by just 3% per year, averaged out over the next 20 years. That's worse than the return that I was suggesting on the municipal bonds of 5%. Way worse than what I said about the S&P 500, which I think was 9.1%, with dividends reinvested, and worse than that syndication example I made at 12%. It only beats high yield savings. And obviously, to keep all of these examples similar, we're not considering inflation in anything. Well, now, after 20 years at 3% gains, that house would be worth $541,000. And you might be thinking to yourself, okay, well, fine, Kevin. But after 20 years, I'm gonna have to have selling costs when I go to sell. I have to pay a realtor. You know, it's expensive to sell a house. You have to pay commissions and escrow. I can trade stocks for free. That's fair. Well, let's compare your $20,000 at 12% over 20 years in the syndication fund. And then after 20 years, you sell. And let's say they don't even charge you fees to sell. So you literally turn $20,000 into $192,000. Cool, you got $192,000. Best case scenario with one of these other options. Well, now over here, you have a $541,000 house, and we're gonna have to pay some selling costs to sell it, so $541,000. And let's go ahead and take off 7% to sell the house. Realtors, escrow, title. You know what? Let's do 8%, because let's put a little bit of money into fixing it up again at the end, even though you've been putting all of your cash flow into fixing the place up. Let's just be ridiculous here and take off 8%. Great, so you're left with $497,000. Now, you got a loan on the property, so we have to subtract out the loan that you have on the property. Well, since you got a 30-year fixed rate loan, you've been paying off principal every month, not cash flow, you've just been paying off the loan every month because you gotta make your mortgage payment. We're gonna take off the remaining debt. Well, the remaining debt after 20 years is $130,738. Now, oh, wow. You're left with $366,982. Wait, what? Why? Why is that possible? Did I screw up the math? What is going on? The high yield savings, you turned $20,000 after 20 years into $28,000. The municipal bond fund, you turned it into over $50,000. The S&P, you turned it into over $114,000. And the 12% return, 12% every single year on your $20,000, you turned into $192,000 after 20 years. But wait, with buying a $300,000 house that breaks even because you keep investing the money back into the house to keep it fixed up, all the potential cash flow, you've now turned $20,000 into $366,000? What? That's almost twice the return that the syndication created. Now, just a quick note, this example that I came up here with, this $20,000 invested and the $300,000 house, that was me 10 years ago. See, the thing about me is I always like to look at the things that I did well and the things that I did wrong so that I can learn from them and do better going forward. So I always try to revisit this example and I go, what am I missing? What am I missing? Like, why is it that I was able to make so much freaking money with real estate? And I finally found the answer, and I could break that down into 4 reasons. First, control of value. Notice control of value is actually different from control of money. See, when I first bought that house, I had $20,000 into the deal. So I had $20,000 that I had control of. I had $20,000 worth of money I had control of. Same thing when you first invest in that syndication, you first invest in that index fund or whatever, you got $20,000. Great. Now you're just waiting for compounding to happen over time. And realistically, over the long run, you don't see real estate going down and stocks going up or vice versa. Everything kind of tends to move together, which makes sense because as soon as one thing starts outperforming another thing, like if real estate starts making a lot more money than stocks, then you get stock people moving over to real estate and sort of equalizing the value. Same thing, stocks start doing really well, people leave real estate and go over to stocks, you equalize the value again. So the whole market kind of moves together. But the first big difference is control of value. With $20,000, I was able to take control of a $300,000 asset. When I invested in the syndication or the index fund, I took control of $20,000 worth of value. Now, I know you might be thinking, well, come on, Kevin, I can use leverage in stocks too. Sure, you can, but it's a different kind of leverage, a dramatically different kind of leverage. In fact, let me put it this way. On an index fund or stocks, yeah, you could get a margin loan. The problem with margin loans, though, is you're usually paying higher interest rates of somewhere between 5 to sometimes as high as 9% on your money, where in real estate right now you're paying around 3.75% interest. But beyond that, with stocks, if you have $20,000 in value for stock, you might be able to take out $10,000 worth of a margin loan. But with $20,000 of cash, I could take out an essentially $280,000 loan. The power of leverage is significantly larger in real estate. And then you might think, well, come on, Kevin, but that's riskier. You have more debt. But the flip side is in real estate, you could usually rent out the property and have a tenant pay the debt for you. And even if you don't cash flow day one, you usually cash flow after you raise the rent after a few years. But again, with our real estate example, we're assuming zero cash flow for the entire 20 years. Whereas in stocks, we're reinvesting dividends. But okay, let's say we took that margin loan up front, and you know what, I'm not even gonna talk about the interest. Let's just go ahead and say with stocks, you took the margin loan and you put $30,000 in for 20 years. Cool, at 9.1%, you're left with $171,000. Still half of what you made on the real estate deal. The other thing to keep in mind is if the market flash crashes in a margin situation, your stockbroker can automatically sell your stock at the bottom. In real estate, if market values plummet, the bank can't call you up and say, give us our money back, because you signed a 30-year contract that the bank won't foreclose on you as long as the payment is made. So your ability to control more value in real estate puts real estate way beyond the returns of any other asset class that you can invest in. And this continues to be true until you're a multimillionaire and you can't take advantage of these golden ticket opportunities where you can get 10 to 20 of these 30-year mortgages and take advantage of this massive blow up in value. In theory, you could buy a property every year with 3 to 5% down and extrapolate this even more ridiculously. In fact, that brings up your potential for control, which is another thing that can increase your returns in real estate. When you own this $300,000 property that over time is worth $350,000, $400,000, $450,000, you could take out safer forms of leverage again, like a home equity line of credit, and use that money to go buy another property and another rental property. So not only do you upfront control much more value with real estate, but you also have much more potential to control more value. On top of that, you get a third benefit that a lot of people only value once they actually get into it. Once you start owning real estate, you start gaining a lot of experience that comes with being an owner. You start learning, oh, that's how you replace a faucet. Oh, that's how you do a light fixture. Oh, that's how ceiling fans work. That's how painting and drywall works. Wow. These are all these experiences that generally you don't get when you're a tenant, which means you're forever stuck in this fear of, oh my gosh, what if I have to do maintenance to my house? Whereas when you talk to any savvy real estate investor, you wonder why when you talk to them and you ask them, hey, aren't you worried about maintenance on all the real estate you own? Psh, no, it's easy because you get jaded into realizing it's not that big of a deal. oh, but what about the roof and what about this? You know, oftentimes when I get comments like that, by the way, I think to myself, I feel like people think that when they go to buy a house, they don't inspect the roof and get a reasonable expectation up front as to the life of the roof. If you get your roof inspected and a roofer goes, hey, for $200, I'll give you a roofing certification that is a guarantee that this roof will last another 5 to 10 years, well, there you go. Slam dunk. You've just insulated your roof risk. There's so many ways to solve these little things that come up. I talk about so much of that in detail in my real estate investing course and the property management course. I'll also be in Vegas, by the way, on the 20th. So if you're gonna be there the 20th of this month, February here, I'll be having a one-day in-person crash course. You can meet me, ask questions. And just a heads up, I don't sell anything at my crash courses. In fact, all I'm doing is providing you food and info. Promised. Now, the fourth thing that we didn't even get to value in these returns we talked about is what you can do in terms of taxes. See, when you go to sell, you're gonna have to pay some taxes, but real estate makes it surprisingly easy for you to take all the money you made, reinvest it into real estate again, and not pay any taxes on it. You could tell the government, hey, I'll catch you later, I'll catch you later. And in fact, in real estate, there are ways to never pay taxes on the money that you made. So all of a sudden, when you put this whole pie together and you start thinking to yourself, whoa, I got $20,000 to invest. I got $50,000. I had $100,000. I got $200,000 to invest. You ought to start thinking about the four things that we talked about here. Your ability to control more value, your potential for controlling more value, the experience you gain owning real estate, and the tax benefits that you get from owning real estate over some of these other investing strategies. And so this is why, to me, the best answer for building wealth, the best answer for how to invest your first $20,000, your first $100,000, is go buy real estate and then wait.